Up when September ends. Okay, let's get started here. That's all fun and games, but seriously, September has had a lot of rate increases for consumers, for loan officers, for agents. Rates are a direct correlation in demand. And so when rates were, when we went up into the fives, it softened demand a little bit. When we got up into the high fives, like in July, it did affect demand. Agents reported to me they didn't have as many people at their open house, or instead of 5 or 6 offers, maybe they had 1 or 2 offers. Maybe they had to wait 2 or 3 weeks to get those offers. Now that we are officially in the sevens, right now we are officially in the sevens, it's going to be interesting to see what the affordability that a consumer will have on a payment, and what exactly is the pain threshold, right? Earlier in the year, and I did a market update, I predicted that rates were going to go up into the 8s and 9s. I follow a lot of really smart people, and all the things that they were telling me with the forecast of the economy, the world political environment, and just everything led me to believe that we were headed that direction. So we had really urged a lot of our clients, to take action or to buy that house, lock in the rates. And we've largely been in a rate lock environment since, I think, February, March of this year. When I'm just right. So traditionally, rates go up. It affects affordability, affects demand, affects prices, right? When the last few months, though, I mean, we've had buyers out there in the market, and in Orange County, Rancho Cucamonga, Upland, Ontario, parts of Riverside, Temecula, I am not coming across sellers that are paying closing costs and points for my buyers. I do know that it is happening. We've seen builder prices decrease because of buyers' commitment 6 months, and they couldn't lock the rate or whatever. There was a lot of fallout of new construction, a lot of really good deals there right now. But what I really want to just share with you is, I think a lot of times when people are like, oh, the rates are higher, what are they really, right? So I put together a little chart for y'all, and we're going to go through that now. Let me pull it up. One thing I want to tell you is that this is not intended for consumer use. This is not an offer to lend. It's just us sharing with you what it looks like, what the rate looks like for a different, like 17 different scenarios. So rates are based on a 720 FICO, 450 loan amount, loan processing, no discount points unless otherwise noted. The first thing I want to call to your attention is that we are doing home equity lines of credit for owner-occupied properties, for non-owner properties, and second homes. And in some cases, we could close super, super fast, 5 to 7 days. We also have and those HELOCs are fixed. You can do 5-year, 10-year, 15-year. It's really a flex term. It's what you desire and where you desire your payment to be. And those HELOCs are, let's say if you're self-employed and you have a lot of money in the bank, but you write off a lot of your income so you don't show income, these HELOCs work really well for our self-employed borrowers and people that have money in the bank. Sometimes you'd get approved when you wouldn't normally get approved by other HELOC lenders. Also, a lot of the banks and credit unions, I don't know if you've heard, but they're taking 60, 90 days to close these loans, your HELOCs. And so at the same time that you're waiting, the rates are just going higher and higher. So, and we also have an interest-only HELOC product as well. Let's take a look at FHA. So FHA is hanging out in the high 6s, VA mid 6s. Now, one thing that I've noticed that was interesting about conventional is when you're looking at the conventional rate, look at the 3% down versus 20% down. So, I mean, usually there's more of a difference in the spread putting 20% down. Okay, let's see. So 3%, 5%. So look, we're in the low to mid sevens, and this is with a 700 credit score. So if you have somebody that, has a lower credit score, it's going to be higher. And that's one of the things that we really impart again to our clients and to our consumers is if you're getting ready to do a refinance or a home equity line, make sure you get your credit in as best condition possible to take advantage of the lowest rates. High balance purchase. Now, this is something that I thought was interesting here. High balance. So those are loan amounts over the loan limit right now is 647,200. However, TDR Mortgage has access to an investor that will lend on conforming loans up to a 750 loan amount. So that's really, really important that you don't have to do high balance. So on a lender that is, where do we go? Where's that high balance? High balance purchase. So if your lender isn't able to do this, if your lender is just going off the normal loan limits, right, which is the 647,200, then you're going to be in high balance territory. So that's one thing to really carefully consider. Now, look at this 25% down investor purchase. I thought this is really interesting. Usually the investor purchases are like 1% higher and more expensive. And when you look at this investor purchase, it's 7.625, costs 1 point, where the high balance purchase costs 7%. And we couldn't go any higher. So one thing that's happening right now that's really interesting in mortgages is lenders, almost all the loans are costing a little bit of money. And it's almost like you can't raise the rate high enough for some people that have low credit scores or special circumstances because the lenders don't want to get stuck with these loans churning. And what that means is lenders make loans for longevity. And when you refinance out of a loan in a few months, everybody loses, right? The mortgage broker, the lender, all of the associates affiliated with the lender. It's very, very expensive to originate loans. So right now, lenders are being very, very cautious as to their rates, and they're trying to keep the rates as low as possible, just in case the market corrects in the next 1, 2, 3 weeks and comes back lower. That happened the last time we had the rate increase. The market reacted strongly, rates went up, and then they went back down a couple, 3 weeks later. So everyone's hedging against that happening. However, we don't have a crystal ball, right? So we're in a strong lock mode right now with all of our loans. And you can play the market. Some people are playing the market and just kind of floating if they're in an active purchase and they don't have to lock right away. That is a strategy that some people are using. Now, refinances. Most people are not refinancing right now because they have low, very, very low interest rates. One of the things, let's just look at the rates really fast. So no cash out refi, 7.1. No cash out refi, 15-year loans aren't that much of a bargain anymore like they used to be. A refinance, conforming, cash out, 7.5. So see there's a little bit extra cost between no cash out here and cash out. And then cash out refi, high balance. We had to up this to a 740 FICO because at 720, it was just pricing out terrible. So, and this one, we upped it to a 740 FICO score. I think we did that on something else too. No, I guess not. Okay. Let's look at the non-QM. Now, I feel like the non-QM is a really good value right now for investors. Take a look at this 25% down owner-occupied bank statement purchase of 7.8, and the same investor, basically no doc loan, where we go off of your rent. So the debt service coverage ratio loan is one where you can buy an investment property, and if the rent is $2,000 and the payment is $2,000, it qualifies for this debt service loan, and we're not looking at your taxes. We're not looking at too much. So it's a really good value. And let's see, what do I think is going to happen in the future? I mean, gosh, so many people are predicting a crash, right? An epic crash. Other people are saying, well, most realtors are saying, buy, buy, buy. I mean, you rarely hear a realtor saying don't buy, which I think it's funny, but I really think that most people in our industry are of the ilk that you should act with caution and act in a way that it's going to benefit you, right? I wouldn't make a move where I'm having to shovel out, $100,000 and my payment is going to be pushed to the maximum and I can barely afford it. And, I don't have a lot of money put back for an emergency. In that kind of a situation, maybe it's good to remain in your rent of $2,500 or $3,000 a month and just save and improve your credit. But if you need housing, a lot of people don't have a choice. They need to buy. Just remember that if you go in and purchase with the strategy in mind that when the recession comes full steam, some people say that we're not in one, some people say that we are. I don't know, it kind of feels like we are. When the recession hits, and this recession, from everything that I'm hearing, is supposed to hit pretty darn hard for a lot of reasons. I mean, we can all agree that inflation is, I've never experienced this before. Last time inflation was a thing, I was in high school and not paying a lot of attention to it. So for me, this is my first time being in this high inflation environment. So it's kind of, I don't want to say scary, but it makes me be cautious with my purchases. And this year I've really pulled back in everything, in every area, so that I can save as much as possible and and carry out my life as lean and mean as I can. And when the recession comes, they are going to lower the rates, right? They're going to save the day. That's what they always do. But we at TDR Mortgage, we want to impart upon you that we want you to act with caution. We want you to make moves that are affordable and that you're not going to get in trouble in the future. And if you are looking to buy, sell, or refinance, pick up the phone and call TDR Mortgage today. We'd love to be a resource in your purchase journey or to assist you with getting some quick cash out. Have a beautiful day.